Hey everyone, and welcome. Today, we're going to dive into what is honestly one of the most powerful tools for building wealth, owning stocks. And we're not just talking about numbers flashing on a screen, we're talking about owning a real piece of the most innovative and important companies on the planet. So let's get right into it. All right, so think of this as our investor's journey together. First up, we're going to tackle the silent problem that's probably eating away at your savings right now. Then we'll explore the two main engines that make stocks work, growth and cash flow. After that, it's time for a crucial reality check on price, value, and risk. Then we'll get into the strategies for winning the long game, take a quick peek at some more advanced tools, and we'll finish up with what is, without a doubt, the most important asset you'll ever have. So let's kick things off with a big why. I mean, really, why can't we just stuff our cash in a savings account and just call it a day? Well, it turns out there's a sneaky, silent problem lurking in there. You know, we're all taught the same thing, right? The bank is the safest place for your money. And when it comes to keeping it from getting, physically lost or stolen, that's absolutely true. But is it really, truly safe? There's another kind of risk, a hidden one, that never shows up on your bank statement. It all comes down to the sneaky thing called inflationary risk. It just means that over time, stuff gets more expensive. Your groceries, gas for your car, the cost of housing, it all tends to go up. So while that dollar figure in your bank account stays exactly the same, its actual power, its ability to buy things, is slowly shrinking. It's kind of like having a bucket with a slow, invisible leak. You're not losing dollars, you're losing what those dollars can do for you. And that right there is exactly why stocks are so important. See, when you own a stock, you own a piece of a real business. And what do businesses do when their costs go up? They raise their prices. So as that company makes more money to keep up with inflation, the value of your little piece of it, well, it has the potential to grow right along with it. It acts like a shield, protecting your money's buying power. Okay, so now we get the why. Let's get into the how. How do stocks actually make you money? Well, there are basically two main ways. Two powerful engines that can drive this wealth machine. Let's call them growth and cash flow. First up, you've got growth. You'll also hear it called capital appreciation. This is the one everybody knows, right? You buy a stock, let's use Apple in this example, for $300 a share, and you hope its value goes up so you can sell it later for, $600 a share. Simple enough. But then there's the second engine, cash flow. And this comes from dividends. This is where it gets really interesting, because the company literally pays you cash, a piece of their profits, just for being an owner. So what in the world is a dividend? Well, it's exactly what it says, a direct payment from the company to you, the shareholder. It's your reward for being an owner. And you can take that cash and spend it, or, and this is super powerful, you can use what's called a dividend reinvestment program, or DRIP, to automatically use that money to buy more shares of the company. That means your next dividend payment will be even bigger. It's a beautiful thing. Okay, if that's still a bit fuzzy, think about it like real estate. It's a perfect analogy. Growth, or capital appreciation, that's like flipping a house. You buy it, maybe fix it up, and sell it for one big chunk of profit. Bam. Dividends, on the other hand, are like buying a property and renting it out. You get that steady check coming in, month after month, year after year. It's that consistent cash flow. Both are great ways to build wealth, just different approaches. All right, so we've talked about all the exciting ways to make money, but let's get real for a second. To be a smart investor, you have to understand the other side of the coin, risk. And this isn't about scaring you away, not at all. It's about getting smart so you know exactly what you're getting into. There's this fantastic quote from Warren Buffett that just nails it. Price is what you pay, value is what you get. See, the price is just that number flashing on your screen. It's the sticker price. It can be all over the place based on emotion and news. But the value, that's the real deal. It's what the company, the actual business, is truly worth based on its earnings and its future. And those two things, they aren't always the same. Let me give you a super simple example. Think about a pen. You could buy a really cheap pen for like $0.25, but what happens when it explodes in your shirt pocket and ruins your shirt? Was that cheap pen really a good value? Heck no. Now, a quality pen, it costs more, for sure, but it works, it's reliable, it has real value. Stocks are the exact same way. A cheap stock price doesn't mean it's a good deal if the company itself is a meh. Okay, pop quiz time. This is a really important one for understanding risk. So let's say you have a stock and it loses 50% of its value. It gets cut in half.
How much does it need to gain in percentage terms just to get back to where you started? Think about it for a second.
The answer? A whopping 100%. Yeah, if your stock goes from $100 down to 50, it has to double, a 100% gain, just to break even. It's this weird little mathematical glitch, and it teaches us something so important. Avoiding big losses is absolutely critical. It's way harder to climb out of a deep hole than it is to just not fall in the first place.
And that idea of risk brings us to something called the pecking order. You need to know where you stand if things go really wrong. So if a company goes bankrupt, who gets paid first from whatever's left? Number 1, the bondholders. These are the lenders, the people the company owes money to. They're first in line. Then you have preferred stockholders. And way down at the bottom of the list, that's us, the common stockholders. We have the highest claim on the potential profits, the upside, but we also take on the highest risk if the company fails.
Okay, so now that we're clear-eyed about the risks, let's talk about how the pros win. How do successful investors stack the deck in their favor? The secret, and this is a big one, isn't about being the fastest or the busiest trader. It's about using time and, believe it or not, taxes to your advantage. And one of the absolute biggest built-in advantages for investors is taxes. I mean, the system is literally set up to reward you for being patient. Here's how it works. You buy stock, and if you sell it for a profit in under a year, you pay short-term capital gains, which is taxed at your regular, higher income rate. But if you hold that exact same stock for just one day longer, more than a year, and then sell it, boom, you pay the long-term capital gains rate, which is much lower for most people. It's a huge difference.
But wait, it gets even better than that. This is where the real magic happens. See, as long as you don't sell, you don't pay any taxes on your gains. That means your original investment, plus all the money it's earned, gets to keep growing completely untouched by taxes. This is compounding. It's your money making money, and then that money starts making its own money. It's like a snowball rolling downhill, getting bigger and faster all on its own.
You know, the market is a moody beast. It goes up, it goes down. Just look at this table. It shows the average monthly returns for the S&P 500 over a 65-year period. You can see clear patterns, right? December, November, April, they tend to be pretty good months. And then you have poor old September, which has historically been the weakest. But here's the real point. Don't try to time this stuff. The big picture here is that despite all these little ups and downs, the long-term trend has been powerfully, consistently positive. It really proves that old saying, it's time in the market, not timing the market. So buy and hold is an amazing, powerful strategy. But it's also worth knowing that stocks are way more versatile than you might think. There are some more advanced tools out there that let you navigate different market conditions. Okay, so everyone knows the classic way to make money, right? Buy a stock, hope it goes up. But did you know you can also make money if you think a stock is going to go down? Yeah, there are strategies that let you do that, essentially letting you bet against a company. And one of the main tools for both sides of the coin, betting for or against a stock, is something called an option. So what is an option contract? Well, at its most basic level, it's just an agreement that gives you the right, but not the obligation, to buy or sell a stock at a specific price for a specific amount of time. Now look, we're not going to do a deep dive on option strategies today. That's a whole other explainer. The big idea I want you to take away is that the more you learn, the more you see how flexible and powerful these tools can be. Which brings us perfectly to our final and I think most important point of the day. We've gone over stocks, risk, taxes, all of it, but there's one asset that underpins everything, the one thing that will truly shape your financial future. This quote from Rich Dad, Poor Dad just says it all. Old ideas are their biggest liability because they fail to realize that while that idea was an asset yesterday, yesterday is gone. Isn't that powerful? The biggest liability you have isn't a bad stock pick. It's an old idea. It's thinking that what worked for your parents or what worked 10 years ago is still the best way forward. The single greatest asset you can ever have is your own knowledge and your willingness to keep learning. So I'm going to leave you with this one final thought. Think about it. Your money is always working, 24/7. Whether it's sitting in a bank account, slowly losing its power to inflation, or it's invested in a company changing the world, it never sleeps. So the real question you have to ask yourself is this. Are you its best manager? Thanks for joining me for this explainer.